Welcome to Market Monday from the investment team in the trust department at the First National Bank. There's quite a bit going on over the next couple of weeks on the economic front. We've got a new conflict in the Middle East. You've got the restart of student loan payments and lots of things hanging over the economic outlook and the market outlook. Let's get right into it and see, where are we at? Are things really as bad as the news seems to suggest, or do we have cause to be a little bit more optimistic, which is what we think. Going into it, we get information about retail sales coming up, which is expected to show a deceleration. That is not declining growth in sales, just a deceleration of the growth in sales from the 0.6% month-over-month reading to the 0.3% month-over-month reading that analysts expect for this next iteration of the news. We'll get information about industrial production, which is supposed to come in flat, or at least expected to come in flat. Information about the housing market, the labor market, and let's talk about the labor market for a minute, because in the past couple of weeks, we got a blowout non-farm payroll report, which basically came in at double what the expectations were. That is extremely strong in terms of an economic report, and it suggests a strengthening economy, not a weakening one. So by extension, that suggests that the Fed may have more work to do on inflation. The business outlook is supposed to show a little bit less sour of a read than it was prior. The leading economic indicators expected to come in at negative 0.4, which again says, hey, we're expecting contraction in the future. But that's at odds with some other stuff that's going to be coming out over the next couple of weeks, notably GDP annualized on the quarter-over-quarter basis, which is expected to show a 4.1% growth. And that's against the prior reading of 2.1%. So is this really a shrinking economy, even though we've gotten a few weak economic reports mixed with some other really strong ones? That's really not consistent information. Durable goods orders expected to come in much stronger than the last reading. We get the PCE price index. We get more labor market information. We're going to get information on income and spending, which income is expected to show a rise, spending a modest decline from the month-over-month prior. And then we get the PCE deflator, which is the Fed, what they like to look at as the preferred inflation gauge. And that's expected to show 0.3% growth. Again, decelerating from 0.4% month-over-month, but still growing. And that indicates inflationary conditions. In fact, when we go to the core, which is what they really look at, month over month is supposed to show an increase from 0.1% to 0.2. So that indicates that inflation is actually potentially getting stronger again. We'll get more information on the outlook. None of that's forecast yet, but those numbers will fill in. And then the main event over the next couple of weeks, the Federal Open Market Committee's rate decision or lack thereof. And right now, it seems that most of the pundits and the market analysts are expecting that to be flat. They're expecting no action there. But if we look into the interest rate derivatives markets, there is a non-trivial percent chance that we're going to see a hike here at the November 1st meeting, and a pretty significant chance of one forecast in for December. Will that really happen? We don't know, but we can tell you that in the context of strong economic reports, much stronger than what we are expecting, that gives the Fed some need to do more than they've been doing and potentially shock the markets with a more aggressive tone. And when you take that in tandem with the equity market, which seems to have solidified, and it seems to have firmed up after a recent pullback, that would suggest that maybe the market can accept another rate hike and they may be inclined to act. So we're going to take that wait and see approach. But looking into the equities themselves, yes, we experienced a pretty decent pullback. This being from the highs. We are now trading about 5% off of the highs and taking back a good bit of the recent drops. So market's trading in a tight range ahead of a lot of this interesting data. And this is strong because we've got conflict in the Middle East that's a new random factor. We've got ongoing conflict over in Ukraine. We also have, since October 1st, seen student loan payments reset, and when that happens, lots of discretionary income is potentially being moved over from the discretionary income to being carved out to pay back existing student loans, which have been, paused for the past several years, and it remains to be seen whether that's really going to dampen spending. But if it does, we can expect a slowdown in the economy to be exacerbated. Nevertheless, this pattern actually doesn't look as bad as it did a few weeks ago, and especially now with things remaining relatively firm, even in the face of a major new catalyst, the conflict over there overseas. We're mildly bullish over the future. Again, we take a longer view. We'll come back and we'll close there like we always do. Oil. One might expect that oil should have spiked on the news of conflict in the Middle East, and it has not. That's interesting. We're paying attention to that. I wonder why that's happening. Does that telegraph that we're potentially seeing a recessionary force creep into the market, a lower demand for energy? Maybe. Or maybe that's a function of opening up of strategic petroleum reserves. We don't know. But we're watching that as well. In terms of interest rates, the yield curve has shifted up. It's continuing to shift up over longer time frames, and that means that inflation expectations by market participants continues to rise. 10-year yields are now at 4.71% on the Treasury, and that is up from a month ago when they were at, 4.29 or 4.32. So that is a pretty significant rise in yield, and that suggests that, markets are adjusting to this idea that we'll be in a mildly inflationary environment, or at least relative to recent decades, for the foreseeable future. So we're watching that, and in the interim, from the perspective of corporate bondholders, where rates are uniformly above 5% across the curve, it's a good environment for the income investor. It's a good environment for the equity investor. We have a bullish outlook, especially if we go out and look over the longer term like we like to do. Are we really worried about a slight pullback? Not so much. Yes, we are entering the end of the year and the volatile period. We're almost through October, and that September-October period is typically historically the worst. In terms of having the highest odds of big pullbacks. We did in fact and are in fact seeing a pullback, but it does seem to be firming, even in the face of bad news, and that's good. And when we take this long-term approach, these short-term events don't really take us off track, and they should not. We have a long-term outlook that's a good plan to get to our financial goals, and we want to stick to it. If you've got questions, if you've got concerns, we're happy to talk. Hope you've enjoyed the video. Have a great day.